Hey everyone, and welcome to This Explainer. I am absolutely thrilled to be here with you today because, well, we're going to demystify a topic that is literally crucial for anyone trying to navigate today's housing market. But honestly, it's a topic that gets so widely misunderstood. We are talking about down payment assistance, or DPA. If you have ever felt totally overwhelmed by the sheer amount of cash required just to get the keys to a new home, you are absolutely in the right place. Our goal today is to break down exactly how down payment assistance works, keeping it strictly to the facts so you can finally see it for what it truly is, a seriously powerful strategic tool.
Okay, let's dive into this explainer. We've got a very clear roadmap today. First, we'll look at the down payment hurdle. Then, we'll define what down payment assistance actually means. After that, we'll explore our three main options: grant assistance, forgivable assistance, and repayable assistance. Finally, we'll wrap up with structuring your home purchase. Let's get right to it. Section 1. The down payment hurdle. Overcoming upfront costs. So let's just acknowledge the reality here. For a massive portion of prospective homebuyers, the biggest, most stress-inducing hurdle isn't the monthly mortgage payment, it's the upfront cost. I mean, it is incredibly common to look at your bank account, realize you don't have tens of thousands of dollars in liquid cash just sitting around, and immediately assume you're permanently sidelined. You might think to yourself, there's no way I can afford a house right now. But actually, I want to directly challenge that assumption today. A lack of liquid cash does not, I repeat, does not automatically disqualify you from homeownership. Take a look at this quote with me, because it really hits the nail on the head. Not every buyer needs more savings. Some need the right strategy. This is a massive paradigm shift, guys. We absolutely have to stop viewing down payment assistance as some sort of, financial bailout for people who can't save. Instead, we need to start viewing it as a legitimate, highly strategic financial tool that can help you structure a winning file.
Section 2. Defining down payment assistance. What is it exactly?
Before we get into the exact strategies, we need to know what we're actually working with. And first things first, we've got to systematically debunk a huge myth. You've probably seen those flashy ads online promising free money for anyone or no money down, guaranteed approval. Throwing around phrases like that is just, well, it's highly misleading. The reality is that DPA is qualified assistance for specific buyers. Both the buyer and the property have to qualify based on strict program guidelines. So no, it's definitely not a free-for-all.
So what is it, really? Down payment assistance is actually a really broad category of help. It's not just a single magic product that works the same for everyone. The funding comes from all sorts of places. We're talking state and local governments, housing finance agencies, nonprofits, federal home loan banks, and honestly, sometimes even your own employer. And the best part? It's super versatile. Yes, it can be used for down payments, but also for closing costs, renovations, or even permanent interest rate buydowns to help lower your monthly payment.
But, of course, there's always fine print, right? To ground us in reality, let's briskly rattle off some of the common program requirements you'll run into. Most of these programs look at income limits based on your household size. A lot of them require first-time homebuyer status, though actually scratch that. Not all of them do, but it's common. You'll definitely need to meet minimum credit scores and debt-to-income limitations. You'll usually have to complete a quick homebuyer education course, and almost universally, there's a primary residence requirement, meaning yes, you do actually have to live in the house.
Section 3. Option 1. Grant assistance.
Now that we know what we're dealing with, let's look at how this assistance actually functions in the real world. We're going to use a simple rule of 3 framework today to understand the main categories of DPA, starting with our first option, grants. A grant is often considered the absolute cleanest type of help you can get. Why? Because it hands you upfront funds to close the deal without tacking on a new monthly payment. And typically, a pure grant does not require repayment. It's just a true, straightforward boost to your purchasing power.
So who exactly should be looking at this option? Well, grants are brilliantly suited for buyers who have a nice, stable income and can easily qualify for their main mortgage payment, but they just happen to have limited liquid cash saved up in the bank. It's also specifically for people who are totally committed to making the home their primary residence. Just keep in mind, though, even with a grant, some programs have repayment triggers if you sell the house, refinance, or move out way too early.
Section 4. Option 2. Forgivable assistance.
Now this is where things get really strategic. Forgivable assistance can often provide a significantly larger amount of upfront help than a simple grant. We clearly define forgivable assistance as a second mortgage, also known as a subordinate lien, that gradually disappears over time. The big key here is that it only turns into a lasting benefit if you, the buyer, strictly adhere to the program's rules. And those rules are primarily going to be about occupancy and time.
Let's look at a hypothetical forgiveness schedule to make this concrete. And this brilliantly illustrates how the process works. Imagine you receive a forgivable second mortgage. In year 1, 20% of that loan is forgiven. In year 2, 40%. This just keeps going until year 5, when 100% of that assistance is completely forgiven and wiped out. This second mortgage literally vanishes year by year just for living in your own home. It's pretty amazing.
But, and this is a big but, I must stress a major caution here. Forgivable does not mean automatically forgiven from day one. If you decide to sell the home, if you refinance your mortgage, or if you move out to rent the place to someone else before that forgiveness period ends, you trigger a repayment clause. You will absolutely have to pay back some, or maybe even all, of that assistance.
Section 5. Option 3. Repayable assistance.
All right, moving on to the final and honestly the most traditional category of the three. To really grasp this, let's break down the mechanics of a second mortgage, which the Consumer Financial Protection Bureau calls a junior lien. Step 1, your main mortgage is secured on the home. Step 2, a second completely separate loan is taken out, also using the home as collateral. Step 3, those funds are applied to reduce the upfront cash you need to close the deal. Finally, Step 4, repayment on that second loan begins. Essentially, this creates a layered debt situation.
Now, it's absolutely vital to point out that repayable assistance is not a free lunch. It increases your overall debt load, and depending on the structure, whether it requires immediate monthly payments, deferred payments, or maybe a big balloon payment way down the line, it may increase your monthly housing cost. So while this definitely helps you get into a home sooner, it is really best suited only for buyers who have a rock-solid, stable income and can comfortably afford that full, increased housing payment without breaking a sweat.
Section 6. Structuring your home purchase. The right strategy. We have covered a lot of ground today, so let's clearly lay out your options and compare these three distinct paths side by side. Now, what's really interesting about this slide is how it breaks it all down. A grant usually has no repayment and is best for buyers with limited cash but a totally clean qualifying file. Forgivable assistance is forgiven over time and is perfect if you know for sure you are staying in the home for several years. And repayable assistance, well, that must be paid back, making it an option strictly for those who can easily afford a higher overall debt payment but just need to bridge that cash-to-close gap.
As we wrap up, I want to reiterate our core philosophy one more time. Utilizing these tools is a matter of smart file structuring. It is not a sign of financial weakness. DPA does not automatically mean a weak buyer. It means the file needs to be structured correctly. The big question isn't just whether you can qualify for assistance. It's about figuring out what type of assistance makes the most sense for your personal long-term goals and your future refinance options.
So, I want to leave you with this final, provocative thought to ponder. Will you let the fear of a down payment permanently sideline you from the housing market? Or will you empower yourself, do the research, and find the right strategy to make homeownership a reality? The tools are out there, guys. It is entirely up to you to structure the win. Thank you so much for joining me for this explainer. Keep learning, keep strategizing, and I'll see you next time.